Hi guys, good evening and welcome to what will probably be our last live collab for this semester, and this is going to be our NSS for your June exam. So what I've planned for this evening is to go through an exam paper, past exam paper, and I've chosen the 2020 exam paper. So we'll go through as many of those questions as we can with the time that we've got. And then also just quickly before we start that, I wanted to just show you this document that's on the screen. I'm not going to go through the whole document now. I'll probably do that in a separate session that I'll upload for you. But I just wanted to show it to you because I am going to upload it to your more resources in the meantime so that you can reference it and have a look at it as well. So I call this document the exam prep tutorial, or it's your lesson plan for your exam NSS. And really, again, what it consists of is some quick hints and tips, the real highlights that you have to pay attention to and that you must make sure that you've either mastered these items that I've mentioned on this document, or that you've paid attention to the specific things that I have that I've mentioned, like how many minutes, etc., etc. Okay, so here you say I've got some specific areas that you have to master, and make sure that you've revised and you are 100% comfortable with these items that are highlighted under this section on these next couple of pages. And again, these are the reason that I've put these on this page, because these are the places that the students commonly make their mistakes, or I can tell when I'm marking that they have not mastered these items sufficiently before they started the exams. So this first lot here is just kind of like general indications, but they are so super important, I can't overemphasize it. And then learning unit by learning unit, just again some simple hints and tips, the highlights that you have to watch out for those specific learning units. Kind of like the little key things. Okay, sole trader, L4, partnerships, closed corporations, and then incomplete records for your learning unit 7. Okay, so this document exists. I'm going to upload it to your more resources tomorrow. And then if I've got time, I'll also do a recording work talking through this document as well. Okay, so then I'm going to stop sharing that, and I'm going to go on to share my screen. There we go. And then we'll have a look at the 2020 exam paper. Okay, so I want the entire screen, share audio. Okay, so in a second you should see the kaleidoscope on the screen. There we go. Okay, so now let me go to my PDFs. Just one comment, with every exam that is written, there are at least 3 different exam papers that exist, because we have to allow for the first sitting and the supplementary sitting and the extra sitting, etc. So there are usually more, or not usually, there are always more than one version of a particular year's exam paper. So for instance, now for June 23, there will exist at least 3 different versions. So the version that I revise with you guys might not always be the exact same version that the head office has uploaded on the past exam papers. On that past exam papers portal, if you want to call it that, they only upload 1 paper for each year. So that just explains why sometimes the paper that I cover might not always be the same that they've uploaded. I might not have the paper that they've got, or again, the electronic version that I've got might be different to the one they've uploaded. So that's the reason why I don't always have the same one that they've got. If I do have it, I'll always try and do the one that's uploaded, but as I say, that's not always the case. Right, so let's get going then. So this is 2020. There we go, 2020 paper. So hopefully this is the same one that they've uploaded, and I have an idea that for 2020 we did only deal with one paper, so hopefully it is. But so I've got no sight of what the library does, so I've got no control over that. Okay, so question number 1 was for 40 marks, and this was from Learning Unit 3, which is depreciable assets. So one of our favorite learning units, we have to learn how to manage all of our non-current assets and the depreciation of those assets throughout the lifetime that we own those assets. So very important learning unit. So let's just go and have a look at what we have to do for these 40 marks. 1.1 is for 15 marks, and here they've said prepare the depreciation, which means the depreciation calculation and the journal entries for the years 2019 and 2020 for this one particular non-current asset computer equipment that the company purchased. Okay, so 2 calculations and 2 sets of general journal that we're going to have to do. And then for 25 marks, we've got a pre-adjustment trial balance that they have given us for September 2019. And the required is, here's all the additional information, and the required is for us to prepare the post-adjustment trial balance as at the 30th September 2019. So this is a question that there are many examples of in your textbook, and this is I always think it's the next learning unit 59. Let me just double check my index here. Sorry guys, just give me a little bit. I know there's a little bit of dead air at the moment, but I just want to double check something. I'm sure this is learning unit 4, not learning unit 3. Let me just go take a quick look. Yeah, okay, well, it's not that important. You'll find the information for this question in learning unit 3 and learning unit 3 and learning unit 4, in those 2 learning units where we learn about these depreciation and accrual. Sorry, it's going to bother me if I can't find it. Disclosure. Yeah, it's definitely in learning unit 4, the second section. Okay, so remember also, I've said to you before when we were revising the previous exam paper that we've gone through, when you are sitting down, first of all, with your paper, you must read through the questions and go and have a look at the required and decide for yourself which of these questions you know really well and that you've practiced really hard and you can do quickly, and then you're going to do those questions first. So this is a long question where you know you've got a pre-adjustment trial balance and you've got to do all of these year-end adjustments and then produce the final trial balance. So that you might want to leave yourself some time to think about that and do it carefully. So this might be one of the questions that you want to leave and do later. On the other hand, if you've practiced this and you know all of your depreciation and your 4 accrual journals backwards and forwards, and you are convinced that you can easily do this question in 25 minutes, then by all means go ahead and do this question first. But it is important that you take control of which questions you're going to write first, which ones you're going to leave for later, because you have to manage this time. Those 15 minutes, if you take 20 minutes to do that question, you've lost 5 minutes over the entire paper. You don't get those minutes back again. Okay, so it's very important that you are constantly translating these marks to minutes and you are managing that the whole way through those 3 hours. Okay, so let's have a look at the first one, 1.1. hybrid dealers bought computer equipment. So as soon as you see the words computer equipment, you know that that is an example of a non-current asset. And so you then also immediately know that that's an item that gets depreciated, etc. What I'm trying to say is that when you read these questions and when you take note of things like this, your brain must already be thinking, okay, I know exactly where computer equipment fits in my set of accounts, in my chart of accounts and my trial balance, and I know exactly what I need to do with it. So they bought it for 54,000. So 54,000 was the purchase price, and the date is very important. We bought it on the 1st of July 2018. The equipment is depreciated at 20% according to the diminishing balance method. Okay, so it's very important also that you are 100% comfortable with depreciating assets, diminishing balance method, or the straight line method, so that the moment you see that diminishing balance method, you know exactly how those calculations work. So you've taken a highlighter with you to the exam, and as you're reading through this, this is what you've highlighted, what the same stuff that I've underlined, you've highlighted that so that you can quickly cast your eyes on the important information, and you can do your calculations quickly. So what they want us to do is prepare the depreciation. Okay, so that's number one. Prepare the depreciation, and secondly, they also want us to do the closing transfer entries in the general journal. Okay, the general journal, not the general ledger, the general journal. Remind yourself 1,000 times of the difference between those two things. Of hybrid dealers, and the date is on the 31st of March, so that's the year-end date, 2019 and 2020. Okay. So I always tell the students to draw a timeline. So to draw a timeline means the timeline always starts with the date that the financial year begins. So the first year that they mention is 2018. So that financial year would have begun on, well, it wouldn't have been the 31st of March. That financial year would have begun on the 1st of April 2018, and it will finish on the 31st of March 2019. And then the next financial year will finish on the 31st of March 2020. Okay. So on the 1st of July 2018, so that's say somewhere around about here, 1 July, we purchased our goods for 54,000. Okay. So what you've got to count up is from the 1st of July to the end of that financial year, how many months did you own the asset for in that first financial year? We know in the second year we owned it from the 1st of April 2019 all the way through to the 31st of March 2020. So in the second year we owned it for a full 12 months. 1st of July is going to be July, August, September, October, November, December, January, February, and March. So we owned it for 9 months. In this first year, we did not own the asset between the 1st of April and the 1st of July, so we ignore that, but we are going to count our ownership from the 1st of July to the 31st of March, and then 2019, and then the 31st of March to the 31st of March 2020. Okay, that's how you need to work with timelines. So we've got to calculate the depreciation for this year, the year ending March 2019, and for March ending 2020. And they also want us to do the closing transfer entries in the general journal. Okay, so let's go and have a look at what that looks like. So our calculation for year number 1, which was the year ending 2019, let's get that out. We have got 54,000. I would multiply it by the 20% first. 54,000 times 20%, which will give us 1 year's depreciation. And because it's the first year that we owned that asset, even though it is the diminishing balance method, there is no accumulated depreciation to subtract. So it is just 54,000. Let's write it on the side here. 54,000 minus any accumulated depreciation, which is 0. And then we multiply that by 20%, which will give us 1 year's depreciation. And of that 1 year, we only want 9/12 because we owned the asset only for the last 9 months of the financial year. And then that's how we get our 8,100 Rand. And then you know that your depreciation journal entry is always debit the expense account depreciation and credit the accumulated depreciation equipment. If you had written computers, I would have accepted that as correct as well, because usually in the balance sheet you've got a non-current asset category called, it could be plant and equipment, it could be computers, but as long as it makes sense. And take note also, your accumulated depreciation account must include the name of the category of asset that you have depreciated. You can't just write accumulated depreciation, because we've only got one expense account for depreciation, but we have got many accumulated depreciation accounts. There's one for each category. So we've got ACDEP vehicles, ACDEP equipment, ACDEP plant, ACDEP buildings, etc. Those are all separate because they belong with their, what would we call it, with their, I always say those two accounts are married together. So the vehicles asset account and accumulated depreciation vehicles account, those two accounts are married. They're husband and wife, they belong together. So there must be a separate ACDEP so that there's a partner for the non-current asset account. So your journal entry is then always going to be debit, depreciation, credit, accumulated depreciation, equipment. You write down, and remember, because this is the general journal, very, very important. Excuse me, you must know that the format of the general journal is this one here, where we've got document date details folio, and we've got one debit column and one credit column. This is what our journal looks like, in which we enter all of our sundry. Remember, this is where all of our sundry entries go into the general journal. And by sundry entry, I mean entries that don't belong in any of our cash books and they don't belong in any of our credit journals. Always make sure that whatever you've entered into the debit column, those total amounts equal whatever the total amounts are that you've entered into the credit column for each individual journal entry. So we always use JV, and if they gave you journal voucher numbers, you'd include that there. For each individual entry has got its own number because that acts as the source document. So for this particular journal entry, we would have a printout from our computer asset register, or we would have our actual asset register. That would be our source document. And using that source document, we would then go and fill in a journal voucher telling us which general ledger account we were going to debit and which general ledger account we were going to credit. And then when we've done that, using the journal voucher as our source document, we then come and fill in the general journal, which is one of our subsidiary journals. Okay, have a look at how they've included the calculation that we had to do at the bottom over here. You can include it at the bottom, or you could put it in here underneath the word depreciation. You could have written that calculation there as well. But it's absolutely vital that you do show your workings of the calculations that you've done to get to that amount that you entered. So in the journal, once we've entered one journal entry, and then the next journal entry goes underneath that, indicating that as soon as we've ruled off a line, there is a new journal entry. So above this line, your debits must equal your credits. And that indicates that that journal entry is complete. Usually with the journal entry as well, on this line over here, you've got a short description, just saying, let's say, end of year depreciation calculation. And that's what we call a narration. Narration means, what is the story about this journal entry? Why did I do it? So that was for March 2019. They also said they want the closing entries. So that means our closing entries are, we take all the values in all of our expense accounts and we close them off to the profit and loss account. So depreciation had a debit of 8,100. So in order to close off the depreciation expense account, we are going to credit it. Okay, so that means that this credit over here then transfers the debit out of depreciation and we transfer it into profit and loss. So when we've done this journal entry here, credit depreciation and debit profit and loss, the total carrying value in our depreciation account is now 0 because we had a debit of 8,100. We credited it with 8,100, so a debit minus the credit equals 0. And we transferred that debit into the profit and loss account. And remember, our closing transfers, we do this right at the very end of the year when we are trying to work out what our profit for the year was. And we close off all our income and all our expense accounts to the profit and loss account so that we can calculate our profit. And then we have completed that journal entry and we rule a line. And again, our debits exactly equal our credits. So we know that this journal entry is correct. Our accounting equation is still in balance when we've completed that. Then our next entry sorry, that's picking up that line when I try and type there. I'm just going to put it down there, JV3. We now get to the end of March 2020. So remember, in this year, we owned the computer right from the beginning of the year all the way to the end of the year. So our depreciation calculation, and again, I prefer to do it 54,000, which is its original cost. This is the diminishing balance method, so we must minus accumulated depreciation, which is 8,100. because we are only going to multiply the diminished balance by 20%. And in this case, because we had the asset for the whole year, we are going to take multiplied by 12/12, the entire value of that amount. Okay. So that's our calculation for the 9180. You must show your calculations. And again, the accounts are going to be debit depreciation, credit accumulated depreciation, equipment with the amount that we've calculated. And then again, we can rule off. That's the end of that journal entry. And our debits equal our credits. And then we are going to do the closing entry for that year, which is going to be identical to the previous closing entry. We are going to take the amount that is sitting in the depreciation expense account, which is this debit of 9180 here, and we are going to credit depreciation so that the balance in the depreciation account is 0. Okay, because you can see here, if I credit, sorry, I don't want that. If I've got a debit in depreciation and then I put a credit in the depreciation account, the total balance in depreciation is going to be 0. And that's exactly what the case is when we have done this journal entry. I credit depreciation and I transfer that debit into the profit and loss account. My narration is closing transfer in this case. Okay. And then this over here would have been JV4 if we were numbering them. But I prefer to number them because then it helps you to see. If you've just got JV written in all of them, it's hard to distinguish that they are, each one of those is a separate journal entry and they would each have their own unique number. Okay. So general journal is one I don't know why, because I actually think it's the easiest journal to do, because all you've got to do is you've got to say which account am I debiting, which account am I crediting, and then give a description and show your calculations and rule off. That's literally what you do in the general journal. It really is the easiest journal to fill in of all of the subsidiary journals. So just get used to that, and remember the difference between the general journal. So as soon as you see the word journal, you know it's one of the books of record that you take source documents and you enter those transactions into the journal to record the transactions. When we are talking about the general ledger, that is the collection of all of the individual balance sheet and nominal ledger accounts, all of the assets and liabilities of all of the, let's call it this, assets and liabilities, and all of the income and expense accounts. All of those make up the general ledger. So when you see that word ledger, that indicates that it is a collection of all of the accounts that we've got in our accounting system. Okay. When you see the word journal, that is a subsidiary journal, which is one of the books that we enter transactions into when the transaction takes place. And then all of your journals, when they are completed for the month, those column totals, or in the case of the general journal, each of these individual amounts are posted into the general ledger. And remember also the general ledger is what we call the T accounts. I'm taking time to explain that because honestly, out of everything in first year accounting, that is the one thing that students get the most muddled up with. So again, just sit with a piece of paper and on the left-hand side, write general ledger, and on the right-hand side, write general journal, and then do a little diagram of what is my general ledger. My general ledger is the trial balance, which is the collection of all of the accounts that I've got in my accounting system. My general journal, and draw a little diagram of what the journal looks like, and in that way you won't forget it if you do that. Okay, so that was for 15 marks, and you can easily make up a bit of time there if you do know your work really well. It should not take you not even 10 minutes to do that question, which means you've got saved up an extra 5 minutes to do the second one, which you probably need a little bit of extra time to do this 25 mark question, which is a pre-adjustment trial balance. We have to do the adjustments from the additional information, and then we have to prepare a post-adjustment trial balance. So let's just go and have a look at what that post-adjustment trial balance is going to look like, just so that you know what you're aiming towards. And most importantly, what I wanted to show you here is the calculations that you've got to do in order to calculate what these final amounts are in the post-adjustment trial balance. How are you going to show those calculations? So you can see how they've done it here in the memo, is in any one of these accounts that involves an adjustment, they have included the calculation. They've written the name of the account, and underneath that they've then done the calculation. You can do it like that, or you can have a page for all of your calculations and write them down. They must be headed and labeled so you know which calculation refers to which account. Or you can write out your format for your post adjustment, and then underneath you can do a heading calculations, and then you would do accumulated depreciation, and then whatever that was, and then underneath that whatever the next one, and so on, and then show your calculations like that. A lot of the students have done them like that in their assignments. It's entirely up to you. Remember, it's got to be legible, it must be neat. I must be able to follow what you've done, and most importantly also you must be able to follow what you've done as you're working through the work as well. So we had to do a calculation there. For trading inventory, we have to do a calculation, so you can see there we've made an adjustment. All of these other accounts here are going to be as per the pre-adjustment trial balance, except in the case of some of them over here, these accounts here, and I'm going to highlight them, which are, you will recognize as being your accrual accounts or year-end adjusting entry accounts. They did not exist in the pre-adjustment trial balance. We have added them in to this post-adjustment trial balance. So these are all going to be work-ins, and allowance for credit losses as well. So all of this is in the what we call the statement of financial position section of the trial balance, which is the balance sheet section. These are all of our balance sheet accounts. And we always put the balance sheet accounts first in our trial balance, followed by the nominal accounts section. And the nominal accounts section are all of our income and expenses, which is the section where we work out our profit or loss for the year, because income minus expenses is equal to our profit or our loss. So all of these accounts are then income or expenses. So have a look at the workings again. We've got sales minus sales returns. We have to do workings for the cost of sales. The rent income account was adjusted. Interest income was adjusted. These are all accounts where we made an adjustment to the pre-adjustment trial balance. Office consumables, telephone, depreciation, we had to count it. Allowance for credit losses is a new one. We created that account. And then always at the end of your trial balance, if everything has gone to plan and you've always made sure that you've done the same thing to the debit side as you've done to the credit side, your total debits will equal your total credits. That's why we call it a trial balance. We do a trial balance to check that all the debits equal all of the credits before we produce our financial statements. Okay, so this is, you can see what you're aiming towards from what we started with here in the question that they gave us. This is what you are aiming for and how you are going to do your layout. So, sorry, just give me 1 second. Okay, so let's have a look at the accounts that they've given us in our pre-adjustment trial balance. We've got capital and drawings, so we know that those two accounts are our proprietary accounts. Capital minus drawings equals owner's equity. Those two belong together. Then we've got all of our non-current asset accounts, land and buildings, and motor vehicles, and the account that is married to motor vehicles asset account is the accumulated depreciation vehicles account. Remember, your asset account, motor vehicles, that total is always going to be your motor vehicles at 100% cost, what you paid for them. So what you paid for them minus how much you've depreciated them by is then equal to the carrying value for vehicles. Okay, so that's why those are married. Then we've got a financial asset, which is a fixed deposit. So that is an asset as well, but that's not a non-current asset. That's a current asset. And that is going to be a cash or cash equivalent. And bank is also cash or cash equivalent. Remember, you've got to be able to identify this for when you get to your, if in case they ask you to do notes to the financial statement, you must know your groupings that belong together. Then we've got debtors control, which is also an asset. Trading inventory is an asset. We've got mortgage loan and creditors control. Those two are both liabilities. So both of those also, mortgage loan is a non-current liability and creditors control is a current liability. So remember, if you're lucky and they give you a debit column and a credit column for your pre-adjustment trial balance, you can easily identify which are assets and which are liabilities. Obviously, your capital and drawings are separate. Those are your equity accounts, but everything else in the statement of financial position section, if it's on the left-hand side, it will be an asset, and if it's on the right-hand side, it will be a liability. Sometimes in the question papers, they don't separate the columns into debit and credit. They give you one column with all of the amounts, and then you must be able to recognize which are which. Then in the nominal section, we've got our main sales account. So remember, if you also remember our dead click, the items that will always be on the debit side are expenses, which will be in the nominal account section, and assets and drawings, which are in the balance sheet section. Those always have a debit balance. And then those items that will always have a credit balance on the right-hand side are liabilities and capital, which are in the balance sheet section, and income, which is in the nominal account section. So in the nominal account section, everything that's on the right-hand side will be income, and everything that's on the left-hand side will be expenses. Okay, so it actually that's why our double entry system and accounting equation makes our lives super easy. So we've got sales and sales returns. We've got cost of sales. And then on the right-hand side, other types of income besides sales, we've got rent income, interest income, and service income. And then our other expense accounts is rent expense, credit losses, wages, cleaning materials, office consumables, interest that we paid on our mortgage loan, electricity, rates and services, fuel, advertising, and telephone. And take note here that our pre-adjustment trial balance was also in balance. Debits equal the credit. So remember, in those questions in your textbook, the year-end adjustments that they always ask you to do are always pretty similar. We always have a physical stock count that we do, and we then have to compare the amount of the physical stock that we counted and compare that to our theoretical stock that we have got on our trial balance. So for trading inventory, we have counted 11,000 rands worth of stock. According to our records, we have got, is the highlighter rather, we have got 24,640, but we have only counted 11,000. So we can see we are going to have to make an adjustment there because we have got less stock than we are recorded, and our post-adjustment trial balance, the trading inventory must equal the value of the stock that we counted. The balance must be 11,000. So if we go to our post-adjustment trial balance, you see here we've got trading inventory. The balance must be 11,000. And then the journal entry that we have to do is going to be 24,640 minus, this 13,640 is, is the amount that we have to reduce the trading inventory by in order to get to 11,000. So 24,640 minus 11, we had to subtract 13,640 from trading inventory. But remember, we can't only credit trading inventory with 13,640 because that would be a one-sided journal entry. If I'm going to credit inventory with 13,640, I have to debit something else. And what else? What is when we adjust inventory, what do we debit? We debit cost of sales, which is an expense account. Okay, so there's the other side of the entry for that 13,640 that we adjusted. Then the other item says that when we did a stock count, we also recorded that we have still got on hand 340 rands worth of office consumables. So if we go to the expense side here, we see that we purchased office consumables of 5,400 during the year, which means each time we bought office consumables, we debited the expense account office consumables and credited trade creditors. But now of that 5,400, there's 340 rands worth that we have not used. So if we haven't used it, we can't record it as an expense in this current financial year. We have to take it out of this expense account, which means that I have to credit the expense account office consumables. So if I'm going to credit my expense account office consumables, I've got to debit something else with the 340. And what is that going to be? That is office consumables on hand. So I have created, by doing that, I have created an asset called office consumables, which is then an inventory account. So when I do my inventory note will now consist of trading inventory 11,000, office consumables 340,000. Okay, so remember guys, every adjustment you make has to be debit something and credit something else with that same amount. Then the second entry is depreciation must be provided for on vehicles at 25% per annum. And in this case, according to the straight line method, and in this particular year, no vehicles were bought or sold during the year. So we know that the amount that we see in vehicles cost account over here are the only vehicles that we own. So we are going to take 225 multiplied by the 25%, and that will give us our depreciation expense for the year. So we are going to, where was it? We are going to debit depreciation. There's the calculation with 56,250, and we are going to credit accumulated depreciation with 56,250. So we've got our opening accumulated depreciation balance, and it's going to increase by this year's depreciation. So the total that will reflect on the post-closing trial balance will be those two amounts added together. And we've now got a new account that we didn't have on the original trial balance, which is our depreciation expense account. Then adjustment number 3, the following adjustments must be made to enforce the accrual concept. So remember, we've got 4 different accruals. We've got what I call the expense accrual, where we have got expenses that we haven't yet recognized. Okay, not yet recognized. All that right, recognized. So we must record the expense. We've got this one over here at the bottom, which I call the income accrual, which is income that is not yet recognized. So we must recognize it. So over here we've got wages and salaries that we haven't yet expensed. Here we've got interest on our fixed deposit that we haven't yet recorded as income. So that's an expense accrual. This is an income accrual. And then the other 2 types of accrual are, this is telephone prepaid for October. So this is we could call an overstated expense. In other words, at the moment, we are recording the expense as for this current year as more than it actually should be, because we paid for telephone that belongs to next year's accounts, but we've already paid them, and we've recorded that 1,300 debit telephone credit bank account, but that 1,300 only belongs to next year. So we've got to take that out of the expenses, and we will record it as an expense next year. And then the other one is rent income received in advance, and that is an overstated income. That means somebody paid us before they should have. So our year is ending in September, but this person already paid us October's rental. So we debited our bank account and credited the rent income when we received the money. But this rent doesn't belong to this financial year or this reporting period. It actually is only income that belongs to the next reporting period. So these are the adjustments that we must make. So again, remember, there's got to be a double side to each entry. So we have to recognize wages and salaries of 6,000 Rand. So we have to debit the expense account, wages and salaries. We've got to increase the existing expense by 6,000 Rand. So that's an expense. So it's debit wages and salaries, and we will credit accrued expenses. So because this is in the balance sheet section of our trial balance, that is a liability. Then our telephone that's prepaid, 1,300, we go to our telephone expense account, and we have to subtract 1,300 from that, which means we've got to credit the telephone expense account, and we are going to debit the prepaid expenses account. So we create an asset by doing that. With the rent income received in advance, 3,500, we go to the rent income account, and we are going to reduce it, subtract 3,500 from it, which means I am going to debit rent income with 3,500, which means that I must credit income received in advance. And the last adjustment, accrued interest of 5350, I need to recognize that interest. So I'm going to create my income account called interest income. Oh, sorry, it did already exist. I'm going to increase it by 5350. So I'm going to credit interest income with 5350, which means that I must debit accrued income with 5350. Okay. Double entry principle must apply with all of the adjustments that you make. Then create an allowance for credit losses. So we don't have an existing allowance for credit losses. They said create it in the amount of 870. So again, double entry system says an allowance for credit losses belongs in the balance sheet section. And it's the account that's really married to my debtors control, because debtors control total minus my allowance for credit losses those are the two accounts that go to that belong in your trade and other receivables note. Where did it go? I've lost it. Oh, there. Debtors control minus the allowance for credit losses equals my carrying value for debtors. So if I'm to create allowance for credit losses, that has to be a credit balance, which means I've got to debit something else. So create a liability in the balance sheet side for 870 and recognize an expense in the income statement side. Allowance for credit losses adjustment account. Okay. So that is all of the changes that we had to make, and any of these other line items you just had to like capital and drawings and land and buildings. We go back to the beginning. We just listed them exactly as they were. Vehicles as well, there was no change to that balance. So you work through your list, adjusting those amounts that need to be adjusted, just listing those amounts where we made no adjustment, and creating a new line for those accounts where we had to create a new account as a result of an adjustment that we had to make. Okay, there's lots of questions like this in your textbook as well that you can practice with these identical types of adjustments that we do at the end of each year. I'm 100% positive, well, I shouldn't say that, that you'll get a question like this with all of these adjustments. It's a big question. It's an important section of the work that you need to know, and it really does incorporate just about everything that you learned in accounting 1A together with what you've learned in 1B as well. So it is an important question. Okay, then let's have a look at what the second question is. This one is for 20 marks. Just 1 second. And this is a bank recon question. So learning unit 1, bank recon. And they've said the following information was taken from the books of Zia traders on the 30th of June 2019. You must highlight your dates. It's very important. The items appearing on the bank reconciliation statement. So remember, the bank reconciliation statement is your internal document that you as a business produce at the end of every month. So the bank recon statement is the statement that you drew up. So this is the bank recon that you drew up on the 31st of May. In other words, at the end of last month. Balance as per your bank statement. So that means as per the bank statement that you received from the bank, and you must always indicate whether that is favorable or unfavorable. It was unfavorable, which means it was that is an overdraft. You owed the bank money at the end of the previous month. And it's important that you get that the right way round, because you are going to make, you then have to know, must I add or subtract the other adjustments that I did? So what I would do is to show that it's unfavorable is to put brackets around it, and they deliberately didn't in this question paper because they want to know that you understand this. There was one outstanding deposit, which is a plus because that would have increased your bank balance. There were 2 outstanding checks, which you still had to process. So a check would have reduced your bank balance, so that would have been a minus. And then there was a correction of an incorrect check. See note 2.5 below. We'll go and see now if that was an increase or a decrease. And then with that information, we then had to calculate what was the closing balance as per the bank account as at the 31st of May. Let's just go and have a look at this note 2.5 over here. It says the correction of the incorrect check for 570 refers to a check. So a check is something that our bank wrote out that was incorrectly debited twice by the bank. So the bank took it off our bank account twice. So they haven't fixed it yet. So that is a plus. The bank must add that 570 Rand back to our bank balance. So we should have got, this is still a negative balance, in other words, an overdraft, 23,340 as our closing bank balance. So we've taken minus 25 plus 5,700 minus 1430 minus 2780 and plus 570. Our balance as per the general ledger bank account at the end of May would have been 23,340. And if you have a look at what they're going to ask us to do here in 2.1, the first thing that we had to do at the top was do that calculation to work out what was the balance as per the bank account as at, what was that date? 31st of May 2019. In other words, the opening bank account balance for the month of June. Then we've got a bunch of other information. So let's just go down to the required and see what they've asked us to actually do. So And this is only for 15 marks, which means you've got 15 minutes to do this. Calculate the correct bank balance as at the 30th of June. And it says, hint, start by calculating the bank balance at the 31st of May. So we've done that. And now we must go and calculate the correct bank balance as at the 30th of June. So that means in our books, in our general ledger, the T account bank, what should its balance be for the 30th of June 2019? And these are all the adjustments or changes that they've picked up in the bank, probably in the process of doing the bank recon. Okay, so let's just go and have a look at what the answer looks like. So you know, again, what are you aiming for? We've calculated the opening bank balance. And remember, your very first step that you do after the opening bank balance is you go to your cash book receipts and your cash book payments. And you add the cash book receipts and you subtract the cash book payments balance. That's what they've done there. You could have done it on two separate lines. Here they've done it as a calculation and then one amount. And remember these, when they say the provisional cash book total, that means what is the totals on your cash book payments and your cash book receipts at the end of the month, right immediately before you are going to do the bank reconciliation process. Remember, in our textbooks, in our cash books, we've got a thick line drawn at the end of the month under our last entry, and then underneath that thick line, we then do the adjustments that we pick up as a result of doing the bank reconciliation process. Okay, you're with me. So these are, that's an overdraft balance. We've added money from the cash books. So in this next adjustment, there is a stale check. So you are probably, and I'm not sure if they will still give you questions including checks because nobody uses checkbooks anymore. I think this year for the first time in the textbook, they are using EFTs. They'll mention EFTs, which is electronic funds transfers, rather than talking about checks, which over the last couple of years have kind of like become redundant. But I'm sure most of you know what a check is or was. It was a way of that a business used to pay somebody that they owed money to. It was a physical way. You physically wrote out a piece of paper called a check, and you gave that check to the person that you wanted to pay. They then took that check and deposited it into their bank account, and that's how the money got from out of your bank account and into their bank account. These days, we just do an electronic funds transfer, which means instead of writing out a check, I go to my computer and I go to my bank and I take money out of my bank account electronically and transfer it to the other person's bank account. It's the same principle. We're just using an electronic method instead of a manual method of paying them. Okay, so provisional totals in the cash book on the 30th of June, which means at the end of the month of June, we had this amount in the bank column in the cash book receipts, and we had this amount in the bank column of the cash book payments. So these would have been bank column amounts. Okay, I'm going to just try and find the ones here that are relevant for outstanding deposit. We don't want that. We don't want that one. Still did not appear on the bank statement. I don't want that one. We've done that one. I'm just trying to do this in the order that the answer is in. Where is this 1430? Okay, here, this is the 1430. This is the amount that we're looking for, 1430. Where's the information about that? Sorry, let me just find it here quickly. So in our last bank recon, there was a check that had not yet been deposited by the person that we gave it to. So in the days when we used to have checks, they were only valid from the date that you wrote them out. They were only valid for 6 months. And then they actually expired. And if you tried to deposit a check that was older than 6 months, the bank would have rejected it, which means we used to call that a stale check. And then you would have had to go back to the person that originally wrote it out and ask them for a new fresh check so that you could then go and deposit your money into the bank. So we're just looking for check 116. Somewhere here in the information, they told us that they must have given us the date of the check, or they told us that it was, here we go. This is what I'm looking for. 2.4. Check 116 still did not appear on the bank statement for June, and the check was originally written out to gift of the givers or gift of the needy as a donation on the 20th of November 2018. So if you counted the months to 20th of November to the 20th of December, January, February, March, April, 20th of May, the check would have been 6 months old. And we are now at the end of June, which means that that check is now useless. It has to be reversed. Okay, 1430. So that's why over here we are adding that 1430 back to our bank balance. Because when we originally wrote the check out, we would have deducted it from our bank balance because it would have been in our cash book payments, and we are now reversing it, so we are adding it back. Then the next item we are deducting from our bank account. There's a correction of an error, 3100 to 2780. And this is check 135, this check, which is on our bank recon for 2780. The bank has now processed that check, but they processed it for an amount of 3,100. And then we went and worked out why did the bank process it for 3,100 when we said it was 2780. And we saw that the bank statement amount was correct. So it was our mistake. It should not be 2780, it should be 3100. So if it's our mistake, we have to correct it in our books. So we still have to take off another 320 Rand. Okay, so let's just write at the top of this. This is the bank account in our general ledger, which is, just write here, bank account in our general ledger. So i.e., this is our books. So these must be our errors and, our errors and omissions that we are correcting. Remember, if it's the bank that's made a mistake or left something out, that goes on the bank recon. If we've made an error or left something out, we must correct that in our cash books, which is basically what we do in here. This is and we are adjusting our cash book totals. Then in the information, they tell us that we have received the bank statement with the bank charges on it. So we must record that in our books, the 450. We also on our bank statement received the advice that they charged us 740 Rand interest. So that must come off our bank account. They also told us that there was a check that we had deposited that in the old days they used to call that a bounced check or dishonored check. The bank, there was not enough funds in the other person's bank account, and so the bank rejected the check. So we excuse me, we originally would have recorded that check in our cash book receipts. We now have to reverse it in our cash book payments and take that money out of our bank account again. Then on our bank statement also, there's a debit order that we must record. So you'll see that most of these are coming from, we've picked these corrections up from the bank statement. That one we picked up, the bank charges would have come from the bank statement, the interest on the overdraft, the dishonored check, we would have picked that up. Debit order we would have picked up from the bank statement. The stale check also, we would have picked that up in the bank statement. So at the end of the month when we receive the bank statement, we then make these adjustments that were not yet recorded in our cash book receipts or cash book payments. Then there's another insurance paid twice by the bank. Somewhere here they'll give us that information. Let's just go back. Correction. We'll come back to 2.6. Okay, so here we've got a debit order to the insurance company. This is all of the, these are all of the items on the bank statement over here. And then related to this insurance company, an investigation revealed that the bank has paid the insurance policy twice. So the actual insurance policy should only be 1,800 and they have paid the insurers 3,600. And the mistake was also made last month. So that means in the month of May, 1,800 too much was paid, and in the month of June, 1,800 too much was paid. So we must correct that by adding back to our bank account. This is actually 1,800 times 2. Once for the month of May and once for the month of June. We are adding that back. Okay, so here we just recorded what was on the bank statement, and here we are adding the 2 times 1,800 back to our bank balance, because this 3,600 should not have been 3,600. It should have been 1,800, and that was for May and June. And then the check for 5,400, that is this one over here where it said 2.6. Let's go here. The bookkeeper is in possession of 2 checks that she has not entered into the cash book payments because she's not sure what she should do with them. Check 141 for 5,400 is made out to Guildford's Furnishers, but the check is actually dated for July 2019, which is next month. But the rule with cash books is that the moment that you have recorded that you've paid somebody else some money, you have got to take it out of your cash books. So she has to record that amount as coming out of our bank balance. Because it's committed, we've made out the check, we've given it to somebody, we have to take it off, even though they're only going to deposit it next month. And then this This check here is also something that we picked up on the bank statement, 5,400. Sorry, not 5,000, 5,000. Was 5,000, wasn't it? Oh, yeah. This one, this electronic transfer, is also from the bank statement. Our bank statement showed that one of our debtors had deposited directly into our bank account 5,000 Rand. So we picked that up in the bank statement, so we must record that in our cash book receipts. So we must increase our bank balance by 5,000. And those are all of the adjustments that we must make on our side, so we can then calculate our bank balance as at the 30th of June, according to our calculations, should be 7490, and that is still in brackets, which means that is still an overdraft. Okay, so you can see how careful you've got to be with a question like this. You've got to be able to go through all of the information that they've given us, and we have got to clearly decide this adjustment that we've got to do. Is it on our side? Must it be a cash book payments or a cash book receipts adjustment? Or is it the bank that must make a correction? Must the adjustment be on our bank recon? Okay. And then the second part of the question was prepare the bank reconciliation as at the 30th of June. So our starting point will be May's bank reconciliation, which we've got here. And we must now do our bank recon as per the end of June. So the first item that we start, and because you've got May's bank recon right in front of you on your exam, that's like a crib note. You know, you can see exactly what a bank recon must look like, and you can use that same format. So the first line item on your 30th of June bank recon must be balanced as per the bank statement. So go and have a look in the information. Where did they tell you what the bank statement amount is? Somewhere here. The bank statement received on the 30th of June showed an unfavorable balance of 19,980. So you know that that is your starting point for the bank recon. Balance as per the bank statement. And this is now the 30th of June. Always put the date there. I just always put the date there regardless, because it prevents you from getting muddled up. So remember what we were doing on the bank recon is we're saying, how much does the bank say our bank balance is? And we've got to find the differences between what they say we've got in the bank and what we say we've got in the bank. So this is what we say, bank balance 7490, which we have just calculated here, and the balance as per the bank statement, which was what they told us in the question. So where the bank says we've got minus 19,980 and we say we've got minus 7490, what are all the errors and omissions on the bank's part that are causing those differences? So this is what we've got to go and have a look at. So I'm not going to go through all the information. So the outstanding deposit of 5,700 that was outstanding on last month's bank statement was received. I'm just trying to find here, 57. It did appear on the bank statement, so we know that we can drop that. We don't have to worry about that anymore. This check here, we know that it's stale and we've reversed it. Check 135 for 2780. We've corrected because it did appear on the bank statement, but remember it appeared for a different amount. So we can tick that. We can tick that and we can tick that. Those have all been dealt with. Then we were waiting for the bank to do a correction of this 570, correction of an incorrect check. The bank had to add 570 Rand onto our bank account. 2.5. And they tell us here this error has not been rectified by the bank, which means that we must keep that on our bank recon. Correction of incorrect check. We are still waiting for the bank to add that extra 570 back onto our bank account. Then there's a new outstanding deposit. Let's just find these totals. What is the amount I'm looking for? 15,600. Okay, we've done that. Here we've got two amounts that are not on the bank statement. Show the following charges. We did that, we did that, we did that, and we did that. Here we go. Here's the other one. Our cash book receipts showed an amount of 15,600 on the 30th of June, and that's not on the bank statement. So that we must put onto the bank recon. The bank must add 15,600 to our bank account. That overpayment of the debit order that we corrected in our cash book over here must also be corrected by the bank. So that correction of the overpayment of those 2 times 1,800, the bank must add that 3,600 back into our bank balance. And then EFTs or checks that have not yet showed on the bank statement, that's these two over here, a check or an EFT for 1,200 and one for 680, those two there. That's 1,200 and 680. They were not yet appearing on the bank statement. And then this one here for 5,400. Where's that? I can't see it immediately. Anybody else see it? We did that. I'm not going to spend too much time looking for it, but it will be in this information here somewhere where there was a check number 541. What was the check number? 141, sorry. 138, 140. Okay, I can't immediately pick up where they've mentioned that check, but it must be in the information here somewhere. So that's also outstanding, 5,400. And then this 570, that is the item that was on last month's bank recon, that's still there. So once we are sure that we have recorded all of the items that we are waiting for the bank to, remember these could be, it could be just as a matter of timing, or it could be an error on the part of the bank. And we've corrected all of those. And when we add those all up together, we get 7,490. And the balances per the bank account on your bank recon. So this is the bank recon, which reconciles the bank statement balance to our bank account. That total must equal the total that you've got as being the correct total in your bank account in the general ledger. So that's 7,490. Those two amounts there should equal each other. Guys, this particular question, just looking at the marks, they've got 20 minutes for this. And I think this is quite a tough question to do in 20 minutes. So I would definitely leave this question and that other long question that we had, this one with all of the adjustments, the pre-adjustment and post-adjustment trial balance, although we had quite a long time for that. But this one here, this bank recon, I would leave this to last because this is going to be tight to do it in 20 minutes. And if you get distracted doing this question and it's taken you 20 or it's taken you 30 minutes and you're still battling to get through it, you're then wasting time, you're stealing time from all of your other questions. So just be very careful with that. You have to take careful note of the time allocated to each of these questions before you carry on and do them. Or otherwise, work on the question for 20 minutes. And as soon as you get to the 20 minutes, stop and then leave space and carry on to the next question. That's another way to do it, because then also you know that you're getting all of those items down that you know, and the marks you can get quickly, they're down on the paper, and those bits and pieces that you're battling with, you can always come back and work on later on when you've got time at the end of the paper. But you've got to think about that. Okay, so I'm going to end this recording here, because we've been about an hour and a half now, and then I will go and look through these questions and I will record more of these questions for you and post them up for you on YouTube and send the announcement within this next week, within these next couple of days or up to the weekend. Okay, all right, guys, so I hope that this has I am taking a long time to do these questions and work through them, because I'm giving you a full explanation, because whatever I explain in these questions will help you with other questions as well, just to understand bookkeeping and your trial balances and your accounting equation and your ledgers and your journals, etc. That will apply to all questions that you do, not just these questions. Okay, guys, I'm going to end the recording here. Best of luck with your exam revision, and please remember, let me have any questions that you've got as you go through your revision. Okay, guys, thank you very much. See you next time. Bye.